Greetings all. I'm Lenny Hayes. Welcome to the Trade Hall market update for the week. Last time we touched base last week, the market was starting to turn, and the hawkish views were starting to trickle back in, and we did see a bit of a risky asset starting to sell off, and the anticipated rate hikes pricing did start to increase. So we're just going to touch on what's been happening so far, we'll just go through it from the top. So here's a bit of a look at the live markets at the moment, mainly commodities. As you can see, a decent day so far. Currencies are mixed. Obviously they're mixed, but on a whole up pretty high. Equity futures had a decent day today. Well, stocks are down, but equity futures now are set to open higher, and fixed income, their yield was a little bit higher, so bonds did come off. So let's talk about what's happened. So let's just look at the money market here in the States. So what we were beginning to see last week, there was a lot of chatter and a lot of talk starting to creep into the market that rates are going to have to stay higher, which has been the case, and we did see IIS swaps pricing start to rally higher, and yields have been continually growing. A main bit of data that the US was waiting for last week was the core PCE read, which did come in above estimates. So if we just look at it here, we saw that it came in at actually 4.3%. So above the surveyed result, the surveyed read of 3.9, which was, it wasn't welcomed by the market. Obviously equities especially sold off quite heavily on that news last Friday. And the reason why we just look at the description, just so we can get a better understanding of what it actually is. So it's a PCE deflator, personal consumption expenditure. So it tracks the price changes for goods and services purchased by consumers. So it's mainly just the consumer, it's an isolated consumer price reading. So it doesn't take into account company and corporate pricing and purchases. It's targeted and isolated to household consumptions, which is the central bank's favoured rate of inflation. So for that to stay high and sticky, pretty good indication that an already pretty hawkish Fed is going to continue hikes. And there's already chatter that there could be a 50 basis point hike at the next meeting. So look, as you can see, in the 6 months, it's crept up to 4.1% now, which is pretty high. That seems to be the peak or the terminal yield at the moment. And then bonds and things are still lower. But there's really there's a lot of 4s and 5s up here, and look, I can't see them coming back down until we get some persistent, and the key there is persistent data reads that show a cooling of prices. It's all well and good to get maybe one here and there after a slow month or a seasonal adjustment, but it's got to be continued and for a prolonged period of time, which is just we're not seeing it. When we see maybe an easing inflation 1 month, but it's followed up with a hot employment number or a hot PCE number, So as a result, the S&P 500's come off considerably over since last week, flattened out the last few days, but it's had a pretty dismal run for February on a whole. We'll just look now at the Fed. So this is what the futures market's pricing in for the cash rate. So see here, it's peaked. It's looking to peak at almost 5.5% that is September, and then we may start to see it to ease off down to the low 5s there towards the start of next year. That's still a very high rate, and to have it to peak up at 5.5%, that's a pretty steep increase from considering the ferocity that the Fed has hiked so far last year. The pricing for the terminal rate has jumped sort of, I think, 20 basis points since the start of the week or last week, as these expectations continue to creep up. So it's going to be interesting to see what happens. If we look ahead to the US, actually we can see it back here. Obviously, a whole lot on the calendar. Tonight, there's really wholesale industries, some PMI reads, which tend to be mixed in manufacturing data. So we'll see what happens. But yeah, this week probably relatively quiet. So we'll probably look for the Fed to see what's going to happen there. So yeah, it will be interesting. If we look again to the 2-year bond yields, that's pretty telling there for the month of February. You can see that the yields really just tracked up quite steeply since stabilizing to the back end of 2022. But yes, February especially, that's yields risen quite high, up to 4.8%. It actually broke a 19-year high earlier in the week. So it's ominous signs, and we all know that the bond market is a pretty good, it's a very true and telling market. So it's probably an indication that the Fed's got a way to go yet. But it also shows that the flamboyance and the ambitious rallies that we saw later in 2022 have worn out, and it's all been dealt a bit of a reality check. So that's that on the US side. Now, as a result, we've seen risk assets come off, including the Aussie dollar. Of late, we were up in a high of 71.50 in January, and now look where we are now at 67.60 right now. Just shows the immense volatility that the currency market especially is enduring at the moment. It just shows that the US it rules the roost. It's the key driver of the US dollar is the key driver of currencies. Domestic data reads and domestic events do really have a limited long-term effect, and at the end of the day, the US does dictate terms a lot. Domestically, though, we are seeing the same scenarios. Our inflation remains high, and unemployment it did come down last week, but marginally. But today we had some pretty interesting data points come out. So we had GDP in Australia, which was lower. It came out as expected, but down from the prior read of 5.9%, which did raise a few questions there. And this was also coupled with our our monthly inflation data that came out today, a lot lower than survey, at 7.4% there, down from an 8.4% year-on-year rise in last month. So that said, our unemployment did come off last month, and we need to understand that Australia does have quite high rates of household debt, as well as a large amount of households coming off fixed rate mortgages. So there could be a case raised for the RBA to maybe revise their monetary policy aggression. But look, it's like I said, it's only a couple data reads, and we need to see prolonged environment of lower ratings and lower pricing indications. So look, that's what happened. On the day, the Aussie dollar did come off, but did rally back up in the back end of the session, mainly due to some pretty strong data out of China, which is the other piece of the puzzle. Do have China and Japan on the other ends of the scale in terms of their fiscal and monetary stances and their inflation, and really the economy on a whole is in two different ends of the compass. So look, good signs for the domestic Chinese economy, having their PMI rise to I think it was a 13 or 14 month high. So it's promising signs that the manufacturing industry is picking up there, which did help the Aussie dollar rise. But could have those. We could see more delayed inflationary pressures once if China's appetite for spending and growth continues, as Australia is such a tight trading partner with them and relies heavily on demand out of China. So look, it's going to be interesting to see how that pans out. But we could see a later inflationary spurt derived from that situation. So look, if we look now, we can get my other screen sharing. So if you have a look over here, so this is the Chinese yuan. It rose steeply. Obviously, it's inverted. So the US CNH, that's CNH strengthening throughout the day off the back of those numbers. So like you can say, it's been on a weakening trend for the same as all of February. But yeah, quite a big tick downward there off the back of those Chinese numbers. So yeah, look, it is interesting, but it paints a complicated picture with having China such a dominant economy in the world, having such a different economic environment. And it sort of puts them at odds with the rest of the developed world in terms of how they're going to treat their economy. And so, look, it's going to be interesting. I can't pick what's going to happen, but the back of my mind, I know that at the end of the day, the stimulus and growth that China's experiencing is only going to create some inflationary pressures for the rest of the world. But there's going to be alleviated supply chain pressures and the likes. So we'll see what happens there. We go around and look at the other markets. As of now, we can see that US stocks overnight were down. Got futures up at the moment. The FTSE was up. This is the Nikkei. It had a pretty decent day. Chinese, actual Asian equities had a decent run, all in the green. Hang Seng was actually up 4.2% off the back of those PMI numbers. US Treasury yields were up a bit, so bonds were down. Aussie bonds were up today, so the yields on them fell off as a result of the GDP and inflation numbers. And currencies at the moment, pretty decent day for all currency pairs versus the US dollar. The broader US dollar off a little bit, 5% as we talk. So yeah, a little bit of a bounce back overnight and during the Asian session for risk, as I think the market just stabilizes a little bit. So yeah, look, that's about all at the moment. It's we look ahead for it's going to be sort of a quiet end of the week. Start of March, new month, generally be pretty quiet, but I think, the Fed coming up. We got the Australian RBA, Reserve Bank of Australia, rate decision next week. But apart from that, we'll just see what the next phase holds. But yeah, definitely a turning of the tide, and it's going to be interesting whether this, the hawkishly induced risk will continue. But anyway, we'll see. Thank you for listening, and we'll touch base again next week.